Have a good day, everyone. Today, I am S.Anandapadmanabhan, Assistant Professor, Department of Commerce, Theivanai Ammal College for Women. We are going to discuss an interesting topic in financial services, which is Introduction to Financial System. Now, one may wonder, what is a financial system? As the name suggests, a system is an interconnected system of many components. A system is a network, an interconnected network of various components. As defined by Prasanna Chandra, financial system consists of a variety of institutions, markets and instruments related in a systematic manner and provides the principal means by which savings are transformed into investments. So if we dwell into the definition by Prasanna Chandra, we can see that it is related. Several components are related and they are related in a systematic manner. The components of this financial system. What are the components of this financial system? The components of this financial system are the institutions, markets and instruments. So these components are interrelated. They are so interrelated that they work in a particular way and the investments are made. The savings are transformed into investments. The savings by various players in the financial system is being transformed or converted into investments. Now that is the purpose of financial system. So basically financial system means it is the network of interconnected components. Now these interconnected components are not just arranged, these are arranged in a systematic manner and they work in a particular way which will enable the transformation of savings into investments. So that is the definition of a financial system. Now we have to specifically listen and learn in detail what are these components in a financial system. In this figure we can see what are the components in the Indian financial system. Financial system is basically divided into four: financial institutions, financial markets, financial instruments and financial services. We can see that all these four aspects or components have different and distinct functions in the financial system. For example, financial institutions, what do they do? Financial institutions provide finance or fund to the other players or components in the financial system. Hence, financial institutions shall be divided into banking institutions and non-banking institutions. Now, when it comes to other components in the financial system, we have financial markets, which is further divided into money market and capital market. Financial instruments are divided on the basis of term as well as type. Term means time period, which is short term, medium term or long term. And type means primary, secondary and innovative instruments. Now financial services. These are services that are provided to the investors for investing. These are fund-based or asset-based services and fee-based services. Fund-based services means they provide fund in certain form for investment. In certain companies or corporates need leasing services, hire purchase services, consumer credit, bill discounting, venture capital, housing finance, insurance, factoring, so on and so forth. These are fund-based services. How do they differ from financial services or fee-based services? Because in fund-based services, they provide a particular bulk amount of fund as a service. If you take the example of hire purchase, when the company need to purchase a machinery, a plant and machinery, instead of paying the amount upfront, they can purchase it through hire purchase. Installment payment is involved in hire purchase. Now who is providing that service? These are financial services provided. There are several agencies, financial institutions that provide such services. Now another example is bill discounting. We know what is bill discounting. These are bills receivables. These are negotiable instruments that shall be converted into discounted at a financial institution, and they will give you the money at a discounted rate. Now similarly, there is factoring, insurance, housing finance. All these are fund-based services, and also fee-based services. Fee-based services including merchant banking, credit rating, stockbroking and mergers. These are services provided by these institutions by charging a particular amount of fees. That is fee-based services. Now coming back to the financial institutions, banking institutions, as we all know, include commercial banks and cooperative banks. And non-banking institutions are numerous in India, including development banks, LIC, Life Insurance Corporation, GIC, UTI, Unit Trust of India, etc. Now we will listen to financial markets in detail in the coming slides. Now about the structure of financial system, we are going in detail. What about the financial institutions? What do these financial institutions do? What purpose do they have in the financial system? A banking institution, that you already know, acts as the intermediary. Hence, financial institutions are also often known as intermediaries, financial intermediaries. Now, these financial intermediaries what do they do? They are making the investors and borrowers meet. They are connecting the investors and borrowers. Investors are people who have fund to invest, who have fund to spare, money to spare. Now these people will be able to meet the borrowers. Borrowers are the people who need the money, who need the fund for their business. Now these two people are met through financial institutions. Now another feature of financial institutions is mobilizing savings of the surplus units and allocate them in productive activities. Now surplus units means business or corporates or companies that are generating wealth. Wealth generated by these companies need to be invested in other avenues, profitable avenues that provide regular income. Now this service is provided by financial institutions or intermediaries. It is very old idea that we should generate wealth and keep it in bank or in treasury or vault itself. The modern financial system involves investing and reinvesting, generating wealth and invest that again in profitable ventures. That's the new idea, new business models. Now services to the entities who want to raise funds from the market or elsewhere. This is an important service provided by the financial institutions. Those who want to raise funds and from market or elsewhere, these people can go to the financial institutions. Another important service is promising a better rate of return. Financial system or financial institutions promise a better and steady return to the investors. That is also important. Now another point is types of financial institutions. Financial institutions can be classified into two categories. We have already discussed that: banking institutions and non-banking financial institutions. Moving on, the next component in the Indian financial system is financial market. Financial markets. Now financial markets, as the name suggests, is a market for financial aspects or financial market, financial money and capital. Now money is raised from money market and capital is raised from capital market, if we simply put it in that way. So on the basis of credit requirement for short term and long term, we divide the financial market. We know the money market is a short term market and the capital market is a long term financial market. Money market, as the name suggests, is the market for raising money, and this we raise money for a very short term period at short notice also. The types of money market instruments are call money, treasury bill, commercial paper, certificate of deposit and trade bill. All these are essentially instruments that raise money. cash. But how do they differ? They differ on the basis of who these instruments are issued. These instruments are issued by certain people, and on basis of that and the repayment period, we differ the money market instruments. For example, call money. Call money is used by banks to meet their temporary requirement of cash. And the treasury bill, on the other hand, is issued by RBI to meet the short-term requirements. So call money by commercial banks and treasury bill by RBI. Now another is commercial paper. Commercial paper is a popular instrument for financing working capital requirement of companies. We know companies need capital to operate. The companies require capital because capital is like the blood of the company. If a company needs to operate, it needs long-term capital as well as short-term capital. The short-term capital or the working capital, the capital that is utilized in the day-to-day activities, ordinary course of the business, is called the working capital. Now this working capital shall be raised through commercial paper by a company. Coming on to the certificate of deposit. Certificate of deposits are short-term instruments issued by commercial banks and special financial institutions. Another important money market instrument is trade bill. Normally the buyers, the traders buy goods from wholesalers and they don't pay immediately the money. They will wait for the trade cycle to complete. And during this period, this document is called a trade bill, have a value. Now trade bill is usually issued against the trader, which is payable by the trader, and the wholesaler may be holding on to that trade bill. And this trade bill shall be used as a money market instrument, and it is negotiable also in often cases like bills of exchange. So these are the money market instruments. Money market is a type of financial market. Now another type of financial market is capital market. Before going on to the capital market instruments, let's look at the distinction or differences between capital market and money market. We have already said that capital market is a market for long-term market, long-term fund, and a money market is a market for raising short-term fund. Moving on to the distinctions, instrument dealt in. The instruments in capital market include shares, debentures, bonds, and government securities. These are securities that are held for a very long period. Now money market instruments are, we have already discussed, like trade bills, treasury bill, commercial paper, bill of exchange, certificate of deposit, etc., etc. Now another point of distinction is participants, who are all involved in the capital market and money market. In the capital market, stockbrokers, underwriters, mutual funds, financial institutions and individual investors are involved. And in money market, commercial banks, non-banking financial companies and chit funds are involved. Now regulatory body. The regulatory body for the capital market is SEBI, Securities and Exchange Board of India. We will learn about SEBI in detail in coming slides. Now RBI. RBI is the regulatory body for money market. The money market is monitored and regulated by Reserve Bank of India. Okay. Now let's see what is capital market. The capital market is a market where securities are traded. Securities are long-term securities, and hence a capital market is also known as what? Securities market. And the security market is, or the capital market is further divided into primary market and secondary market, because we already know the long-term securities are traded in capital market. But these long-term securities, if we issue the long-term securities for the very first time, we issue it in the primary market, primary securities market, and any further issue or selling or reselling is conducted in the secondary market. Simply speaking, that's the difference. So primary market deals with the fresh issue of securities or new issue of securities, and hence they are called new issue market or primary market, and Secondary market is the market where existing securities are purchased and sold by the buyers and sellers or security market traders. And secondary market, often we know it by the name stock market or stock exchange. Stock exchange or stock market is the secondary market. It's the market for purchasing and sale of securities that already exist in the market, that is already issued in the primary market. Now, what is a stock exchange? We know stock exchange is another name for secondary market. Stock means securities. And the very important feature of stock market is that it is an organized market. Organized means that is well regulated on the basis of rules and regulations. Disciplined, that's called organized market. Now, what is the purpose of a stock exchange? It provides a place for the existing and approved securities for buying and selling. We can buy and sell bought and sold, buy and sell the securities in the stock market. And it is a transaction takes place between members or their authorized agents. Now, the stock exchange, we can either trade on ourselves or through authorized agents, through stock brokers or underwriters. We deal within the stock exchange or stock market. And as I have already told you, stock exchange is well regulated on the basis of rules and laws. This is done so that there is no fraud or malpractices happen. The fund invested in the stock exchange is the fund of the investors. It should not be going into the hands of fraudsters. There is no malpractices should be happening in the stock exchange. And another important or vital purpose of the stock exchange is to provide all the vital information to the investors. Then only they can make informed judgment. Then only they can make the correct investment to the appropriate or suitable securities. That's why the stock exchange always ensure that the complete information is available to complete people. To all the people, these informations are available. To all the players in the stock exchange. Who ensure that? Stock market or stock exchange ensures that. Moving on, these are the 6 functions of stock exchange. You have to learn it very detail. What are the functions of stock exchange? Now, very purpose of every market is to provide a ready and continuous market. Stock exchange provides a ready and continuous market. Except for holidays, the stock exchange works 24/7. Stock exchange is continuously working. So, the traders can invest and take money or generate money from the stock exchange. Another important function is providing the information about prices and sales. The stock prices or the price of the securities should be known to the investors, and any other vital information that they need to know in order to invest in the securities are provided by the stock exchange. So providing information is very important function of stock exchange about what are the prices of the securities, if it would go up or down. All this information are provided by the stock exchange. Now, another important function is providing the safety to dealings and investments. The stock exchange is a place where investors, individual investors as well as institutional investors, invest huge amount of money. Trillions of dollars of amount is being circulated in the stock exchange. Now, this money is very important. It should not go into the hands of fraudsters. It should not be lost. So, we need to provide safety to the dealings and investment. And who provide the safety? The stock exchange provide the safety to investment. And how do they do that? They will ensure transparency in transactions, rules and regulations, laws. Now, another important function is helps in mobilization of savings and capital formation. We have already discussed that people have money. Corporates generate wealth or profit. Now, what to do with this money? What to do with this fund? We need to reinvest it in profitable ventures. Now, who provides such an opportunity? Stock exchange provides such opportunity. If you have money, if you have the fund, you can invest in securities of any company from across the world through stock exchange. A person having investable amount, a person having fund in their hands in India or in South India like Tamil Nadu can invest in a company situated in America or United Nations or England for that matters, or Europe for that matters. How can he do that? He can do it through stock exchange. Now, stock exchange helps in the mobilization of savings. Similarly, those who want to invest in companies in India, they can approach the stock exchange in India and they can invest that money. Now, mobilization of such savings is possible through stock exchange. Now, another important function of stock exchange is it acts as a barometer of economic and business conditions. Barometer of economic and business conditions. Economic and business conditions of what? Economic and business conditions of a country, of India. If we want to know the economic and business condition, what is the economic condition of India? What is the business condition in India? One may wonder. And we can readily look at the stock exchange and find out. If we look at the stock exchange, if it is growing day by day, then it means that the economy is doing good. The business is going well. If the stock exchange is falling, constantly falling, giving huge loss to the security holders or the shareholders, then it means that the economy is not doing well. The business condition is having some issues. Now, the stock exchange acts as a barometer of such economic conditions. Barometer means barometer is an instrument to check the health. In medical terms, barometer helps to know the health conditions. Now, the health of the economy of the country shall be checked with the help of stock exchange. It acts as a barometer. If something like some economic event like the budget, financial budget is presented by the financial minister, then it will be reflected in the stock market. Or some other issue like the COVID pandemic happens, it will also be reflected in the stock market. It will get affected. Now, any economic events or business conditions will be reflected in the stock market. So, stock exchange acts as a barometer or measure or scale for such economic events. Now, another function or last function is better allocation of funds. Companies generate funds, huge funds, and investing these funds is a very important aspect. It's very challenging too, because the owners of funds, these are shareholders' fund basically. Shareholders' fund are invested in the business, they generate profit or revenue, and they are further carried over to the reserves and surplus. Now, what do we do with these reserves and surplus? This surplus amount is to be reinvested either in the same business or to the new business that will generate huge income. Now, better allocation of funds, we can do it through stock exchange. These are the 6 functions of stock exchange. Now, regulation of stock exchange. We have already understood that stock exchange is a market where millions or billions or trillions of dollars of money is being involved. So, since this much money is involved, someone should guarantee the safety of these stock exchanges. And who would guarantee the safety? The regulatory bodies would guarantee the safety. In India, the stock exchange is being monitored and regulated by SEBI, Securities and Exchange Board of India, which came into existence in 1992. Now, Securities and Exchange Board of India, which came into existence in 1992, what do? They regulate the stock exchange. You should note that they don't control anything. They don't just command people to do this or do that. They don't do any such things. They will just regulate the market. Because if the stock market is being controlled by an institution like SEBI, then there won't be any trading going on. There will be restrictions to the trading. So we need to keep a distance from the stock market, but at the same time someone should regulate. That's why we have a regulatory body like SEBI. Now what role does the SEBI take? What is the role of SEBI? The role of SEBI are protecting the interest of investors in securities. Now the investors' interest must be protected. Stock market should not be a place where people come and invest money and the money will be taken over by companies. That should not just happen. The companies should take the money of the investors and in return they should give a dividend or profit or revenue. And who ensure that? Who ensure the interest of investors? It is the SEBI. Now promoting the development of securities market. The security markets need to be developed in order to generate more, in order to inflush more money into the economy. The economy will be active only with the help of stock market, and the growth of stock market is promoted by who? SEBI promotes the stock market. Now another important role is regulating the stock market. I have already said the rules and regulations that need to be followed by the stock market participants or the brokers or the companies or the investors are laid down by the SEBI. Another role is any matters connected therewith or incidental thereto. Any matters that are related to the stock exchange or stock market are the the matter of SEBI. Now these are the role of SEBI. Thank you. That's all about financial system, Indian financial system and the financial structure. I hope you enjoyed the session. Thank you.